साथियों, हमने कोरोना के समय में
During the coronavirus pandemic, we worked from home and did online meetings. It's the need of the hour to resume those measures.
Indian Prime Minister Narendra Modi says COVID-era measures may need to make a comeback. The comments underscore how the US war in Iran is rippling through Asian economies. But with Washington and Tehran still locked in a stalemate, a full return to normal looks distant. Live from Sydney, I'm Paul Allen, and this is Insight. President Trump and Iran are rejecting each other's peace proposals, struggling to hold on to a fragile ceasefire after 10 weeks of conflict. Asian stocks are climbing despite higher oil prices as traders double down on the AI trade and brush aside Middle East tensions. Beijing confirms the date of Donald Trump's state visit, greenlighting the first US presidential trip to China in nearly a decade. Ahead, Standard Chartered Global CIO Steve Brice joins us, staying overweight on India alongside Taiwan and the US while shifting towards Europe. Also coming up, Biocon CEO Shreehas Tambe on India's crowded fat loss drug market and whether generics could reshape demand for legacy drugs like Ozempic and Mounjaro. Our top story today, there is no end in sight for the 10-week crisis gripping the Strait of Hormuz as the US and Iran reject each other's latest peace proposals. In a social media post, President Trump described Tehran's latest peace offer as unacceptable. According to a Wall Street Journal report, Iran had offered to transfer some of its stockpile of highly enriched uranium to a third country, but rejected the idea of dismantling its nuclear facilities. Iranian media says Tehran has disputed the report. For more, let's get to Bloomberg's Horizons Middle East and Africa anchor Jemana Besetches. So, Jemana, why was this deal rejected?
Yeah, well, Paul, there was plenty of anticipation over the course of the weekend that the Iranians were going to submit their response to that one-page U.S. proposal. And of course, it did come yesterday evening, President Trump characterizing their response as unacceptable. He said, I don't like it. It is totally unacceptable. Now, from what we gather, especially from reports released by the Iranian news agency, this is Tasnim, they're very close to the Revolutionary Guard Corps. What was included in the Iranian response was the necessity of immediately ending the war, guaranteeing no further aggression against Iran, lifting of U.S. sanctions for 30 days, a release of frozen assets in exchange for the lifting of the blockade, but then also linking what was happening in Iran to other regional fronts. And of course, here they're drawing a direct linkage between what is happening in Iran and the regular flare-ups we continue to see in Lebanon, where the death toll continues to mount. So once again, trying to relink the issues, which is one of the core issues that the U.S. have as well, because they've been trying to separate them. The other big item was on nuclear enrichment. And you were just in the introduction talking about the Wall Street Journal reporting on Iran insisting on no nuclear dismantlement. Again, that is a non-starter for the U.S. And the other part of the proposal that also appears to be unpalatable from the U.S. perspective is Iran have said that they were happy to discuss the nuclear file after that 30-day window, where all of the other topics that I just listed would have been agreed to. Only after that 30-day window would they start addressing things to do with the fate of the highly enriched uranium stockpile that they're sitting on, monitoring the possible dismantlement of those nuclear sites. And again, from the U.S. perspective, they can't be seen to be fully ending the war and offering guarantees that the war isn't going to happen again in the absence of some certainty around the nuclear files. So this is where we're at today. Another impasse. The two sides still very, very apart on their respective positions. And we're still in a situation where the strait is still effectively shut and effectively being controlled by Iran.
Yeah, deadlock and hard to see any areas of agreement here. So what happens next?
Well, yesterday, President Trump, even before he put up that Truth Social post, said that they had achieved 70% of their military objectives. So that certainly leaves another 30% of military objectives that are yet to be achieved. The expectation was that they were going to try to wrap something up before the Trump-Xi summit later this week. And now, of course, we know that it's happening between May 13 and May 15. And so perhaps the possibility of a restarting of hostilities in the next few days is low compared to perhaps what might happen after the summit. And there's still hope that China may play a mediating role. At the same time, it's also noteworthy that the Israeli Prime Minister Benjamin Netanyahu was giving an interview yesterday with CBS, and he said specifically there is work to be done. He said the war is not over, as there are still enrichment sites that have to be dismantled, and there's still proxies that Iran supports. So the signaling, at least from the Israeli Prime Minister, is that the war is not yet over. Piecing it all together, perhaps, the U.S. administration will want to give this another diplomatic push, but given how far apart the two sides are, and given this deadlock that you speak to, there's certainly still a possibility that we go back to another round of hostilities. It's certainly not out of the question.
All right, Horizon's Middle East and Africa anchor, Jemana Beseche, thank you. Well, the global tech rally is still seemingly immune from the day-to-day developments related to the Iran war. Traders doubling down on the AI trade, with JP Morgan raising its targets for Korean stocks for the second time in less than a month. Bloomberg's Avril Hong joins us now. So, Avril, what are you looking at?
Well, it's that powerful rally that we're seeing in the Asia Pacific, tracking on from Wall Street's performance. We saw the S&P at record highs, thanks to also in part the jobs numbers and then the earnings story. And of course, it's all about AI and chips in the Asia Pacific. South Korea's gains for a fifth session is far outpacing today what you're seeing on the Nikkei or the TAIEX. And if you look under the hood, it's very much driven by the chip giants and SK Hynix in particular. Some interesting nuances there, idiosyncratic, based on what local media is reporting. Some of its customers are actually offering to pay for its capex. That's how much its chips are in demand. And I think that is also what's behind JP Morgan's call, where they see the memory upcycle lasting not just next year, but the year after that, all the way until 2028. So as you said, JP Morgan is upping Kospi's target for yet another time, following on from Goldman already last week. Its base case, it thinks it's 9K, 10K on a bull case scenario. Now flip the board, take a look at what we're seeing, some other indicators on the Kospi, which is interesting at the time where volatility is picking up on the benchmark. And this usually denotes some form of downtrend for the markets. But this volatility price picking up in the Kospi is coming at the time where investors, both retail and institutional, they are chasing the rally. Also interesting to note that this rally in the South Korean benchmark is coming where, based on the most recent available data, foreigners have actually been selling into the rally. So some nuances to get through there on the South Korean markets. Paul?
All right, thanks very much, Avril. Let's get some more insights now with our guest, who says his market risk indicators suggest a heightened risk of a significant correction in Korean markets in the coming weeks. Steve Brice, Global CIO of Standard Chartered Bank, joins us now. And Steve, to your point, the rally that we've seen in the Kospi is just staggering. It's at 86% year to date. If we take a look at SK Hynix, that's up 190% year to date. So how much more upside is there here? What risks do you see?
Well, I guess it's very difficult to know exactly how much further this can extend when you go parabolic like we are doing in this space at the moment. Korean stocks are epitomising that the most, of course. Who's to say you can't do another 10, 20% in the short term? But the way that we look at it is sort of structurally the semiconductor story is still very positive, but this is very much a crowded trade now. We see people scrambling to revise up their forecasts, similar to what people, including ourselves, were doing with gold at the beginning of this year as well, and obviously we saw some consolidation and correction there. So we wouldn't be surprised at all to see some sort of short-term correction coming through in the coming weeks. From what level, of course, that's really difficult. I think key for us as well is that if we look at the contribution to global equity gains so far this year, semiconductors have contributed around 50% of those gains. So everything seems to be very focused on this. Now, our view is that generally gets people worried about What happens if semiconductors do correct? What happens to global markets? Normally what happens is you see the recovery broadening out. So that's what we've been basically focused on last week when we downgraded semiconductors to a neutral allocation from an overweight, saying, look, yes, it's a good long-term story, but maybe the market's getting ahead of itself here, and we prefer to diversify more across the tech space.
If we did see a correction, what do you think would catalyze that, and how enduring would it be? Because the demand for chips just seems to be pretty much insatiable right now.
Yeah, no, it absolutely does. And obviously, I mean, I was actually in Korea last week, and we were sort of arguing that just because a company is a great company, just because the revenues projections are still very strong, doesn't make it a great investment in the short term. We made a similar argument when I was there in January, and we saw a decline in the stock market of around 20%. I guess the rally we've seen since then has been, quite stupendous. But something similar in terms of a pullback of 20%, I think is perfectly reasonable. Longer term, we still like the space. We still think it's really critical to the AI investment boom. And obviously, we don't believe that's a bubble, counter to a lot of people's opinion. We still think this is being monetized, not just in semiconductors, but in the hyperscalers as well. So from that perspective, this is a long-term trend. We still have space to go. So we would be buying the dip, I guess, in semicon, but just feel there's volatility ahead.
Now, you do expect the global rally to broaden out in the coming weeks. I'm wondering if you can explain to me the reasons for your optimism.
Yeah, I guess part of it obviously comes back to the fundamentals that we're seeing around the world. So if you look at earnings projections, whether you're looking at global equities, right, across the industries, I think all apart from energy looking for earnings growth to be positive this year, and even that's obviously improving with what's going on in the world oil markets today. So that suggests that the basic fundamentals are still positive. Obviously, there's some people are very concerned about what happens in the Middle East and the connotations of that for global growth and inflation. At the moment, we seem to be managing that reasonably well. But obviously, the longer the conflict, the conflict or the challenge in the Strait of Hormuz, with it still being closed, the longer that continues, obviously, the greater the risks become. So, basically, our view is that we should be overweight global equities. We didn't cut in response to what was going on in the Strait of Hormuz, and we still believe an overweight stance remains the right approach.
So we're 10 weeks deep into this conflict now, but does political reality in the United States mean that it gets solved before the midterms? Is that part of the reason you're feeling optimistic about this?
I guess there's reason for optimism and also pessimism, right? So I think maybe on the pessimistic side, when we talk about the two parties that are negotiating, they don't seem to be at a stage where they both want to make it or need to make a deal. So Iran feels it's got better staying power than the US, and with the equity markets at all-time highs. Yes, the midterms are there, but with the equity market at all-time highs in the US, Trump may feel that he's not in a rush either. So maybe we do need to see some short-term correction before we see them really coming to the table. But longer term, we do believe that the Strait of Hormuz will be open. The central scenario is hopefully by the end of this month that might happen. It might slip into the beginning of June. But overall, we do believe that is the path of least resistance here, and that we believe ultimately will bring oil prices gradually lower, not back to where they were, and that will then make the central banks' jobs around the world a lot easier than it is today.
We've got a big week of tech earnings coming up out of China this week. I'm wondering if you could tell us what you're looking out for there, and what's your allocation to Chinese tech at the moment?
Yeah, so we are overweight China and China tech within our Asia ex-Japan portfolios. And obviously the tech piece is a major part of that still. Obviously, it's much less reliant on semiconductors than say than Korea and Taiwan. But overall, we think that that's a space that can continue to do well. We are seeing at the broader country level, obviously, data remaining actually remarkably resilient. We obviously had trade data. We've had growth data for Q1 holding up, although obviously Q2 will be interesting to see what happens in the face of those higher oil prices. And then we had inflation data as well, which most people, you can look at that glass half full or half empty and saying, okay, higher oil prices are creating inflationary pressures, but at least it pushes away the deflationary argument that has been there for some time. So as we know, given the economy is heavily indebted, it's really important that we get positive nominal growth and therefore strong real growth, and then a little bit of inflation on top is actually not a bad environment for the Chinese authorities. So hence the overweight to Asia to Chinese equities.
Yeah, we did get a little bit of inflation on top too with those April CPI numbers out of China. But just sort of moving away from the tech story now, I mean, you talked a moment ago about the broadening of this rally. Are there any underappreciated sectors that you're seeing that aren't getting the attention they deserve right now?
So I guess in the US we've had a barbell approach to sectors. So obviously we are overweight the tech sector, which is obviously working out relatively well, but we're also overweight the utilities area and healthcare. So a bit more. I guess utilities is less defensive than it has been historically and more aligned to the AI story. But healthcare has obviously been underperforming, but we believe that's a good area to be invested in. Increased M&A likely, further deregulation we think should be good for the healthcare sector going forward. So those are the sort of the underappreciated areas of the market today.
Yeah, I want to get back to the healthcare story in a moment, but just sticking with the US and particularly Fed policy, I mean, you still see one Fed rate cut this year. Can you also see a scenario where we get none?
It's possible, of course. I think it comes down to our expected profile for both inflation and then labour market data. So obviously we had labour market data on Friday that was still relatively robust. So a slight uptick in the unemployment rate and underemployment rate, but the headline jobs growth numbers, relatively positive and broadening out across other sectors as well. So from that perspective, that's not really flashing red for the Fed to worry about. And with inflation where it is, you could sort of argue that the Fed should be on hold today, and maybe that could extend further into the future as well. But the way we view it is if the Strait of Hormuz is opened in the next few weeks, oil prices will come down, so we'll start seeing inflation peak, and then we'll see the lagged effect of what's happening today coming through in the labour market data in the second and particularly the third quarter of next year, which will create the backdrop for the Fed to start cutting rates under new leadership, of course. So from that perspective, that's why we're still holding out for that one rate cut. I think for markets, it probably doesn't matter whether you get that rate cut, but what does matter, I think, that we don't see a move towards rate hikes in the US, because I think that would be more challenging for markets as it just flips from a bias to cuts to a bias to hikes. So that would be more challenging. But as long as we keep that easing bias in view, I think markets continue to grind higher.
Yeah, and on the other side of the Pacific, we've got the Bank of Japan just continuing the slow walk towards normalization. What's your outlook for when we get some meaningful tightening from Japan, and what's it going to mean for the yen, which seems very resistant to attempts to defend it at the moment?
Yeah, it does. I mean, obviously, dollar yen has been very, very resilient to rumoured intervention and obviously those rate increases going on. At some point, we do believe that will feed into dollar yen coming significantly lower. So the next rate hike probably won't be until Q3 for Japan. But overall, that we are moving in that direction, and interest rate differentials will further narrow, which should put downward pressure on dollar yen ultimately. But we don't seem to be in a space at this environment where investors are willing to push in that direction. But the way we look at dollar yen is it usually goes up the escalator and out the window. So while the markets are content and think things are pretty much under control, dollar yen can drift higher back towards the 160 level. But ultimately, we do see it that is a good area to sell dollar yen going forward.
Steve, I want to ask you a couple of questions about India as well. Are you still overweight this market? What's your outlook? This is a good time to be buying with the long-term picture in view?
Yeah, I guess it's really interesting. Obviously, we upgraded India at the beginning of this year, which obviously was a bit early. So India has been underperforming. We felt the derating that we saw last year and the greater earnings visibility going into the beginning of this year was going to lead to India outperformance. Then obviously what's happened in the Middle East doesn't help the India story at all. We still believe that valuations look more compelling today. So for investors domestically, it's a pretty decent story. For international investors, obviously you do have to worry about the currency risks as well. But if we do again see the Straits of Hormuz reopen and oil prices drift gradually lower, I think that would be enough to lead to a strong recovery in Indian markets. So maybe I wouldn't necessarily be adding to that overweight today in India, but we will be watching oil prices very closely over the coming weeks.
And Steve, as you're speaking there, we see on the bottom of the screen Prime Minister Narendra Modi has been urging Indians to conserve fuel, to defer non-essential travel. Is that influencing your decision-making at all?
Obviously, we have to take it into account. There's several countries around Asia that are struggling with fuel shortages, and that's obviously, firstly that comes through in prices and changes behaviour. But then obviously there's also the risk that you could see shortages leading to quantity impacts on the economy as well, and that's effectively what we're seeing. I think there's a scope, and maybe COVID helped us in this regard to sort of say we can actually change behaviour in a more or less damaging way, maybe to the economy. So from that perspective, maybe the impact would be lesser now than it would be if we hadn't had COVID. But obviously it does still have an impact on economic activity and corporate earnings. So yeah, absolutely, it needs to be factored into decision making.
All right, thanks so much for your time today, Steve Brice, Global CIO of Standard Chartered Bank. And we have plenty more ahead. Stay with us. This is Bloomberg. Welcome back. You're watching Insight. Here are some of the stories that we're following. Shares of Intel closed higher in the US on Friday after a report that the company reached a preliminary agreement with Apple to manufacture some of the chips in its devices. This is according to the Wall Street Journal, which said talks have been underway for more than a year. But they say it's still unclear which Apple products would use the Intel-made chips. Sony is planning a new joint venture with TSMC as the first step towards what it called a fab-lite approach to semiconductor production. The two companies say the joint venture will develop and build next-generation image sensors for robots and cars, with the project starting in Kumamoto. Sony will be the controlling shareholder of the partnership. We're watching shares of Australian biotech firm CSL after they cut full-year guidance and flagged about $5 billion in additional impairments. It now expects revenue of about $15.2 billion and net profit of about $3.1 billion for the year ending June 30, missing the street estimate. Interim CEO Gordon Naylor says growth initiatives are working, but the benefits will take longer to materialise. Saudi Aramco's CEO is warning of a long disruption to oil markets following the near closure of the Strait of Hormuz. This comes despite the company reporting a jump in profit after higher oil prices and demonstrating its ability to redirect exports through alternative pipelines. The CEO anticipates the oil market will only normalise in 2027 if trade and shipping remain curtailed for a few more weeks. Coming up, China confirms President Trump will visit Beijing this week with a summit slated between him and his counterpart Xi Jinping. We'll look at what's on the agenda up next. This is Bloomberg. Welcome back. You're watching Insight. China has confirmed that President Trump will visit the country from May 13 to 15. The White House earlier said the American leader will meet his Chinese counterpart on Thursday. Our Chief North Asia correspondent Stephen Engel takes a look at what's at stake.
State visits to China of this magnitude usually take months of preparation, countless hours of back-channel horse trading, and optics planned to the most precise detail. By many accounts, that hasn't happened ahead of this summit, especially with Washington's attention squarely on the war with Iran. There's palpable concern here in Beijing that this two-day affair could be splashed with far too much spontaneity for China's liking.
They want no risk, they want a no-thrills summit, and they want deliverables on both sides clearly defined. How do you do that with an administration that is not engaging in the traditional way that U.S. administrations have engaged their counterparts in China?
Is there a clear China policy, do you think, in the White House?
No, I don't think there is.
The issues are endless. Front and center could be the war in Iran.
Iran is the world's largest state sponsor of terrorism, and anyone who's buying oil from Iran is contributing to that. We're looking for stability with China. We don't want this to be something that derails the broader relationship or any agreements that might come out of our meeting in Beijing.
Also, will the two leaders solidify a more lasting trade agreement? Boeing airplanes, soybeans, rare earths, perhaps even the most advanced AI chips could all be up for discussion.
The fact that the U.S. is hosting G20 and China is hosting APEC, which means their ministers are running around in each other's big cities all year long, and the two leaders will meet in these multilateral environments, is also very positive.
But is Taiwan on the table? Xi may want certain assurances from Trump with an arms package to the island pending in D.C. The two sides may end up playing it safe, announcing easier deliverables like better people-to-people exchanges, or even visa-free travel? A long shot for sure, but China has implemented that with many more countries of late as a diplomatic outreach and a way to boost a sluggish economy.
As far as the services sector goes, there's absolutely no question at all that the domestic tourism market is absolutely booming.
Keep in mind, this summit is on China's turf, begging the question, has the Trump White House readied its most effective away game plan?
They're putting a lot of stock on the personal diplomacy between President Trump and President Xi. It's not a long-term strategy. It's a short-term strategy.
Stephen Engel, Bloomberg News, Beijing.
And Steve joins us now with more. So, Steve, what else do we need to watch out for?
Well, it's a lot, isn't it? In just 2.5 days that he's going to be in Beijing, starting Wednesday evening, and then Thursday is going to be a packed schedule where he will have a state greeting, presumably at the Great Hall of the People. He's going to have a walk and talk with Xi Jinping at what we just saw there, the Temple of Heaven in southern Beijing. He's going to have the next day on Friday, he's going to have a working lunch with Xi Jinping in Beijing before flying out. So there's a lot to do. And again, has there been the right amount of preparation time on both sides and coordination for deliverables for both sides? What we're hearing through diplomatic channels is that it's all about the B's and the T's. On the B side is what the United States wants. They want the Board of Trade and Board of Investment, something that Jamieson Greer of the USTR has been talking about. They want a Boeing jet order formalized. They want beef sales committed to, and they want beans. They want soybeans, more soybean purchases. China, they're about the T's. They want to address the tech controls that have been imposed by the United States. They also want to address Taiwan, as I mentioned in that story, and they also want to get an update on the situation as it regards to tariffs.
So let's talk about Iran too. Obviously some substantial differences here. How might that play out?
Yeah, that's a tricky one. That could end up dominating and overshadowing all those other potential low-hanging fruit deliverables, if you will, if the differences are too great. It depends on how strong Xi Jinping stands his ground and how far does Donald Trump on China's home turf push Xi Jinping to address some of the concerns that the United States has, as we just heard from Jamieson Greer there, talking about if you're buying oil from Iran, you're supporting their state-backed terrorism push. So we all know that China is the biggest purchaser. I mean, they purchase almost all of Iran's oil right now. And there are concerns as well about the satellite imagery that the Iranians have been using from Chinese companies, that the United States has now sanctioned 3 of those satellite imaging companies. And then there's the issue of rail links between China overland through Kazakhstan, Turkmenistan to Tehran. Data that we've seen indicates that China is supplying commercial and industrial goods with a great increase in the frequency of trains. It used to be about once a week between Xi'an and central China to Tehran. Now it's every 2 or 3 days sending goods to Iran. Now, the interesting part of that equation is the Iranian officials saying if the train's coming in full of goods to Iran, it could potentially go out the other direction with petrochemicals and fuel. And that, by the definition we just heard from Jameson Greer, would be something that the White House would not be pleased with. So you can see, Paul, 2.5 days is not a lot of time in Beijing for Donald Trump and Xi Jinping to have a meeting of the minds on a lot of issues.
Yeah, not a lot of time indeed. Chief North Asia correspondent Stephen Engle there. Well, Biocon's CEO Shreehas Tambe is going to join us next to talk earnings and if generics will reshape the demand for fat loss drugs in India. That conversation up next. This is Bloomberg.
साथियों, हमें पेट्रोल डीजल का उपयोग
We need to reduce our use of petrol and diesel. During the coronavirus pandemic, we worked from home and did online meetings. It's the need of the hour to resume those measures.
That is, of course, Indian Prime Minister Narendra Modi. They're appealing to citizens to cut fuel use and also saying COVID-era strategies such as work from home might need to be brought back. For more, let's get to Bloomberg South Asia economy editor Ruchi Bhatia. So, Ruchi, some very interesting comments there from Prime Minister Modi. What's behind this?
Absolutely, Paul. Very interesting comments coming in from Prime Minister Narendra Modi. He's asked to get back some of the COVID-era measures, asking people to defer their purchases of gold, defer their foreign holidays. And this is, of course, coming in as we're seeing, twin pressures on the fiscal and on the current account only increasing as a result of the crisis that's playing out in the Middle East. We've already seen rupee hitting record lows one after the other. India's foreign exchange reserves also declining. In fact, the lowest in a month that we've seen as of May 1st. And, this is a sort of a signal. One should take these comments with a lot of seriousness, given the fact that so far the government has been, government's state-run companies have been absorbing the losses on fuel prices. So we do expect some sort of a fuel price hike coming in the days to come. Having said that, one also needs to see that this is a sign to say that it's becoming very hard to absorb any kind of pressures on the fiscal and on the current account side as far as the government is concerned. This is a result of a lot of conversations that have happened between India's finance ministry and the Prime Minister's office, and the Prime Minister, in fact, urging the citizens at this point of time. These measures that the Prime Minister is talking about they are not mandatory, but they are definitely a very important signal of what's to come, and also shows that the government is finding it very hard to fend off the pressure on the currency and foreign exchange reserves.
Yeah, you mentioned it's getting hard to absorb these pressures. What's that going to mean for policymakers then? What's the plan?
This definitely means that perhaps they may have to pass on the fuel price losses to consumers. We've already seen that the state election results are out. So perhaps we may see some sort of, those losses being passed on. In fact, oil marketing companies are seeing losses of about 300 billion rupees so far. So that has become a big concern for the government. Also, this means additional pressure on the government's fiscal math. While we're just about 2 months into the fiscal year after the budget was presented on the 1st of February, but this does mean that some of the numbers that the government was working with will definitely come under question. In fact, some of the analysts are already talking about a hit coming in for India's growth as well. The Reserve Bank of India, in fact, has also said said that a 10% hike in crude oil prices will have ramifications on growth and on inflation. They see a 15% decline in a 15 basis point decline in growth and a 30 basis point jump in inflation for just a 10% rise in crude. So we will see ramifications as far as India's GDP is concerned, as far as inflation metrics are concerned as well.
All right, Bloomberg South Asia economy editor Rishi Bhatia there in New Delhi. Well, meanwhile, Novo Nordisk saw a 40% surge in sales of its diabetes and weight loss drugs in India last month after steep price cuts boosted demand for its branded treatments. Now, this is even as generic GLP-1 therapies have flooded the market. For more, let's get into India consumer and healthcare reporter Satviki Sanjay joining us now. Satviki, why did Novo cut prices and how are generics posing a challenge to Novo in India?
Hey, hi, Paul. Yes, generics in India, they've come on for GLP-1 weight loss drugs. India is the first market globally where generics have come in, and that obviously means that innovators, Eli Lilly and Novo Nordisk, are trying to refigure how the market dynamics will evolve. As these generic drug makers launched, their medicines for prices as low as $14, Novo Nordisk, it has been the most hit company because of its compound. It had to cut prices as much as 48% for Wegovy, its weight loss drug. In April onwards, that effect has started to come in the market. Now its drugs cost about $60 for a starting price of Wegovy and Ozempic.
Okay, so this is the first market in the world where generic Ozempic has become available. So when generics come into play, how's that changed the game for other drug makers?
Generics have essentially helped expand the Indian weight loss and diabetes market because of extremely low pricing, extremely affordable pricing. That obviously means there will be some competition that Eli Lilly and Novo Nordisk will face now onwards. Now, of course, this has been the first month for first full month of sale of generics in India. That means that the results haven't really started affecting both either Novo Nordisk or Eli Lilly, and instead these drugs have helped expand the market. Of course, as more consumers start using it, they'll prefer cheaper options, and which is why Novo Nordisk has been ready with price cuts in India.
All right, that's India consumer and healthcare reporter Satviki Sanjay there. Thank you. Well, let's take a quick look at how Indian markets are tracking at the moment. We've had about 10 days now of the Nifty pretty much going sideways. We're seeing it Nifty 100 losing a bit of ground here. We're off by about 1% at the moment. And just in the context of those remarks we had from Narendra Modi urging the citizens to cut their fuel use, avoid unnecessary travel, we'll be obviously keeping an eye on Indian airlines, jewellery companies as well. They're expected to show a little bit of softness today. India Hotels going to be reporting results as well later today, so it'll be interesting to hear if there is any commentary from them. But at the moment, we're seeing some modest losses across the board for Indian equities in the first minute or so. Well, joining us exclusively now is Shreehas Tambe, CEO and MD at Biocon. Shreehas, thank you so much for your time today. I just want to pick up on some of those remarks that Satviki was making about generics, generic GLP-1s in particular. You saw a 17% jump in adjusted generic revenues this year. How much of this is thanks to your early momentum with these therapies?
First off, thanks for having me on your show. And I was listening into the comments that Satviki just made, fair comments. And I think one of the most important things is to see how can you get these drugs which can many more people than it was doing before, because these can certainly help address some of the lifestyle ailments that people are dealing with, and obesity is certainly one of those. So if we can help address those with a large section of people being able to afford them, I think that's a big win, and that's what we are in for. Now, specifically to what our numbers have been, we've seen in our generics portfolio a steady increase over the course of the year, particularly on a like-for-like basis. We've grown, like you just said. On the back of the peptides portfolio, we've been the first to get our Gen 1 GLP-1 portfolio, which was the liraglutide product in the European region. And I think that's starting to see traction. We have approval now in the US, and we will be looking to grow that franchise in the coming year.
You say in the coming year. Can you tell us a little bit more about your go-to-market timeline for the US? Because that was quite the win for you.
Yeah, I mean, we're very excited with what we've got in the US in terms of not just the GLP-1 product that we've got, which is the generic liraglutide, which is both the generic to Victoza and the generic to Saxenda. But more importantly, it dovetails very nicely with our biosimilar insulin portfolio. We're the only company, I would dare say, which has a biosimilar insulin and a biosimilar or generic liraglutide portfolio approved in the United States. That just tells you our commitment to the market and to the particular metabolic disorders that we're dealing with. It's not a surprise that the companies that have got these GLPs to the market today happen to be insulin companies. It does place us in that particular segment where we will look to leverage the capabilities in manufacturing to scale, because we have a fully integrated company. And we will bring them to customers because we understand the patients and the devices that they use over a long period of time.
Well, we were hearing from our reporter just a moment ago. I'm sure you heard her, Satviki, talking about the amount of competitors in this space now. What's your plan for defending margins as generic versions of the Ozempic drug become more common?
Yeah, and I heard that comment that we were expecting some of this to come through. And like I've said, even in the past, we don't see this as a sprint. We see this business as a marathon. And this is something that you'll have to stay with the patient for a long time. These are chronic therapies. Like I said, we've been with our patients for the insulin's portfolio. It takes a long time to build trust. This is not just about cost arbitrage and pricing of products that can get you through the initial, through the gates and as you start. But to be with the patient and to win the trust and confidence takes commitment and takes a fully integrated portfolio, which is what Biocon has. And we believe we're going to be there for a long haul. So that's a really differentiated strategy, not just fighting it out on cost or pricing, but to be able to offer a larger, wider portfolio of products and services.
So how's your company looking at growth and biosimilars businesses in fiscal year 27? Because I'm curious about which segments you think are going to boost growth.
Fiscal 26, first of all, was a tremendous year for us where we really reset how we're going to go forward. We've got a very strong biosimilars business that we built, and that's setting us up for a very strong growth in fiscal 27. We just talked about the generics portfolio. We talked about the excitement that we see there in our peptides portfolio. But on the biosimilars part, we've been very successful in 3 therapy areas, oncology being the leader in the biosimilar space, US leading the way for us. But we've been very successful recently, even in Europe. We've got 5 products launching in the US this year in fiscal 27, and we will be looking to grow that franchise in the coming year. So you will see growth coming in on the back of new product launches, and you will see us gain steady market share. We've got 1/5 of the market today in oncology in the US, and our insulin franchise continues to exceed now $300 million globally. So that's just a commitment that we have to the diabetes, obesity space, which we are calling diabesity.
Now, I want to tell you, I'd like you to tell us a little bit about your earnings. The fourth quarter net income was a little bit of a miss, but you've been talking also about the need to consolidate heading into fiscal year 27. So can you tell us a little bit about your profit in the context of what's coming up?
actually quarter four was quite successful. I would put it that way. If you were to adjust the generics business for the one-off situation with the generic lenalidomide which we had last year, even the generics business had a healthy growth over last year. So that's very encouraging. So that business has grown. Biosimilars, of course, grew very, very strongly. You've seen a 16% growth year on year with a EBITDA margin growth of 40%. That's really tremendous. So I would say the full year basis and the quarterly performance, both for biosimilars and generics, have been good. We had a research services business which went through a challenge because of a single large molecule customer who had a challenge in their market. But we've seen that recover as well on a full year basis. That business on the services end also has grown 2% with the recovery of the EBITDA margins as well. On a consolidated basis, we've seen a 200 basis point expansion, which is quite, a growth in a year where you see challenges and headwinds. So I think from a financial metric perspective, not only have we grown the top line, but it's grown profitably, which is how we're looking at the business. Most of our capital investments are behind us. We are seeing operating leverage starting to play into the numbers, which is why you are seeing the EBITDA margin expansion into the P&L.
Now, just briefly, Shreehas, you also mentioned in your earnings report a complex geopolitical environment, perhaps an understatement. What's your biggest risks in the supply chain at the moment? How are you building resilience?
Yeah, I mean, one of the things I was listening in on your show, and clearly all of us want to see the situation stabilize, normalize very quickly. Particularly what is affecting us at this point in time is not so much of the product supply in and out, because these are life-saving drugs. It hasn't impacted us from the continuity of products in and out of where we need to get them to. We built a resilient supply chain, but it certainly is beginning to see an impact on the cost of transportation of goods. Now, from the question to see how we're building resilience, we've always been present closer to customer. Being a fully integrated company, like I said before, we have the ability to set up operations closer to a large customer base. And we've been doing that over the years, even before this current crisis that we see. And that's starting to help us more and more as we go, so we don't have to ship glass and water across the ocean. So that's really helpful. And you'll see us do more of this.
Shreehas, we are out of time, unfortunately, but thank you so much for joining us today. That is Shreehas Tambe, CEO and MD at Biocon. Now, tomorrow, we've got a whole lot of interviews with top executives, including the CFO of Titan, the CEO of Indian Hotels Company, as well as the president of global pharma firm Daiichi Sankyo. So make sure you tune in for those conversations. But that is it for Insight. Horizons Middle East and Africa up next. This is Bloomberg.